And now for the Money Rundown. Our Money Rundown segment is where we cover the week's news. There's lots of media sources out there that are going to give you updated information about the economy, about the markets. Our job is to help summarize and synthesize, help pick out a few stories that are most important for you as a retiree or an investor. Joining us today, financial advisor Stephen Murphy. Stephen, welcome.
Hey, Scott. Glad to be here. All right, Scott, our first story. Primary season is officially over. Former President Donald Trump and President Joe Biden are set to square off in the November election as both took commanding leads in the delegate counts for their respective party nominations. So it begs the question, do elections matter for your money?
Thanks for the story, Stephen. It's a big topic of conversation with clients. Do elections matter? And I think historically, there's a ton of data that we've gone over with people before on your ability to make money regardless of who's been president in the past. Mixed Republicans, Democrats, split Congress, different White House. You've been able to make money in a lot of those different environments. We even look at our recent history. Biden was president, we've made money in the market. Trump was president, you made money in the market. And if you look historically, that's really been the case. I think one of the most important things to know is going into an election year, the 12 months prior to a presidential election are typically very positive. Now, one of the things I would say is historically, the first quarter is often the slowest quarter going into an election year, and yet we've been red hot. So we might have had a bunch of the earnings for the whole year already pulled forward. We're going to have to keep an eye on where things are at with that. But I think the election this year has less to do with where the market's headed. It has more to do with inflation. It has more to do with what the Fed is going to do and if earnings can keep on the right trajectory. Stephen, what do you think?
Yeah, I mean, I think this is politics is something that obviously is very near and dear to most people's hearts, and it's an easy one to get fixated on when it comes to your investments and your retirement plan as a whole. We meet with people all over the political spectrum, and everyone has a fear that if the opposing party gets into office, that it's just the end of the economy. This is something that we see commonly that around elections. Again, if someone of the opposing party to your beliefs gets elected, we get the emails and the calls and the meetings that I want to go to cash, I want to go to precious metals, all of the quote unquote safe investments because they feel that the market's going to just fall off a cliff. So I would push back and encourage you as an investor to realize that the reality is that data doesn't quite agree with that. It's easy to have that fear and that emotion about it, but this is one of those ones where you really kind of need to take a step back and understand that most big market corrections that have occurred throughout history occurred from an external catalyst and not necessarily who was in the Oval Office. So just keep that in mind. Don't make any rash decisions and speak with good mentors and guidance to make sure that you are staying on track.
Good stuff, Stephen. Yeah, I think that so much of our job is, and we deal with people that are far right wing, far left wing, middle, all over the spectrum. I think our biggest challenge is thinking through all the stuff that's being proposed or talked about or that becomes law. How does it impact your bottom line? How does it impact your pocketbook? How does it impact the investment strategy? And what's crazy is sometimes what you think is going to happen doesn't happen, right? When Biden was elected, I thought the energy sector was going to get hurt. And it wasn't the case. Energy rallied really strongly for the first couple of years after Biden was elected. So the question is, no matter what you might be facing in the world, how does it fit into a strategy? I think overall, as long as you approach things, you're not making knee-jerk reactions and panicking. It's part of a bigger picture. You've thought it through. You've thought through the pluses and minuses. I think you're going to be in a much better spot.
Our second story, AI everywhere. Will AI, artificial intelligence, keep pushing markets higher, or is the bubble ready to burst? The value of the Magnificent Seven ended 2023 strong, but there are some cracks forming and some new leaders are emerging. So how do you profit from artificial intelligence, or are you already too late to the party?
The AI question is huge. Everybody's talking about it, and it's been a huge driver in the market. I was looking at one of the biggest AI stocks today, doubled in the first 2 months of this year. It's been just crazy to see the growth. Anything that's talking about AI has been rallying. And what's been interesting this year is the Magnificent Seven now is at the Magnificent Six, 5, 4, 3. There are definitely some cracks emerging. So what can you do? I think AI is going to be part of the conversation for decades to come. We are in a revolutionary period. I think what's really interesting is seeing companies, their earnings have been growing dramatically. It just hasn't just been hype. Some of the biggest movers have seen big moves in earnings. And I've seen some companies where the PE ratios, even though the value of the stock has doubled, the PE ratio stayed the same because the earnings have doubled. So that's been really interesting to watch. And I think you've got to start thinking about what are going to be the other beneficiaries of AI. You have to be careful because I think it's starting to feel like a mania. With some of these companies that have been rallying so strong, so quick, you're bound to have a little bit of an air pocket. And I think if you're going to be an AI, I think you want to be looking at players that are proving it with earnings. I don't think you want to be speculating with companies that are losing a bunch of money, that have negative earnings per share. I think you want to be looking at companies that have proven and demonstrated that they can grow the bottom line. That'd be one thing I'd be talking about. And also think how it fits into your overall risk tolerance, right? Where can you take risk in your portfolio? Maybe you're more aggressive with the Roth portion. Maybe you want to buy and hold an individual position in a taxable account. How does it fit in your overall picture to see where AI is going to be appropriate? Stephen, what are your thoughts?
Yeah, I think artificial intelligence is commonly said to be the next internet. And I think there's a lot of truth to that. But I think when you look back at most major cultural technologies that have come into play, whether it be even the automobile 120 years ago, the most recent one has really been the internet. When you look at it, it really has been hard to pinpoint specific companies. For internet, you look at old internet providers, browsing companies. You weren't investing into one company that owned the internet, for lack of a better term. It really just becomes a part of all companies. So artificial intelligence is probably going to be the same, that it's not one company or a couple companies that dominate artificial intelligence, but rather artificial intelligence is just another technology that every company throughout culture is utilizing in some way or another, just like every company nowadays is utilizing the internet. So there's going to be companies that come around that are utilizing artificial intelligence that don't even exist yet. When you look back at some of the primary internet companies, I guess you would call them, the services that they're offering go through the internet, but they're not internet companies per se, whether it's search engines or social media. They utilize the internet, but they are not solely internet-based companies. They're just creating a service and a product offering based off of that technology. And artificial intelligence is probably going to be the same way.
I mean, AI is definitely everywhere. It's got to be part of your overall investment strategy. But I would say I think you do have to consider what the implications might be to individual companies, individual businesses, especially if you got a high concentration in an individual stock, right? Does a company like Google have increased risk to their search engine dominance because of what can happen with AI? Does Microsoft have more potential because of their Copilot product? Who are some of these leaders? I think that with AI, you're going to need companies that have a budget to make an investment. And so some of these bigger companies may stay bigger. And what we've seen even this year is some big divergence in which companies have been doing well and which ones haven't. So I think it's important just to add that when you're thinking through your investment strategy, how it might impact what you're looking to invest in. And certain sectors may be taking advantage of that AI technology more than others, as well as certain companies. So have it inform your overall opinion and overall investment strategy.
Our next story, the February jobs report came out showing that the unemployment rate moved higher to 3.9%. So is some cooling of the job market a positive or a negative development for the market as a whole?
I think cooling of the job market is a definite positive. Too tight of a labor market has really contributed to inflation. So the fact that it's cooling, I think, is good. I think it's more likely the Fed's going to cut interest rates second half of the year with a cooling jobs market. What we also saw is not only was the unemployment rate creeping up, but they revised their previous job reports. I think 10 of the 12 past reports have been revised. And so that job market definitely has been cooling. I think it's a positive. Murph, what do you think?
Yeah, I mean, I think everything you said, I agree. I want to caveat it with some context that it is very, very, very unusual times that we're in, that rising unemployment is actually a good thing. Typically, when you see unemployment rising, the economy is not doing well. It'll probably have some negative impacts on GDP, earnings of companies, all of which are negative in normal times. But this is a market condition that's pretty unique. So yeah, seeing the unemployment rate rise is likely, again, beneficial to lowering inflation and therefore the Federal Reserve cutting interest rates. So if you're a listener and you think, okay, anytime I hear higher unemployment, that's good, caveat it with the fact that that might be the case now, but in normal times and normal market conditions, that's typically not the case.
Perfect. And that's our money rundown for this week.